Okay, so we can now go into investment appraiser. So let's go back to the mind map number 1. First method, net present value. So you should be very familiar with present value of cash inflow minus present value of cash outflow. So if the net amount is positive, it means financially viable. Positive, inflow from the project more than the outflow for the project. If NPV positive means profitable project. Okay, when do we use this one here? Remember, net present value, the discount rate is cost of capital. It's a cost of capital, WACC. WACC, all right? So when can we use net present value? Remember, the condition is gearing remain constant. Gearing after you take the project remain the same. Why? The reason is whether it's Modigliani and Miller. Of course, we are talking about taxation. There's no point talking about no tax. So we always talk about if there's taxation because company pay tax. We know that in real life there are taxation. So whether it's Modigliani and Miller, if there are taxation, we know that if you change a gearing, let's say it's 50%, you change it to 100%, we know that the cost of capital change. And the discount rate for NPV is cost of capital. Now, if the cost of capital change, we're in trouble because too complicated to handle the other costs. So gearing change, cost of capital change. We cannot use net present value. It will not be accurate. So that's Modigliani and Miller. Of course, traditionally say the same thing. If gearing change, cost of capital change. So unless you keep the gearing same before take the project, after take the project. If you keep it the same, then we know that that is a cost of capital, that's a discount rate. So that is a reason why using net present value, we must assume the gearing remain the same or capital structure remains the same. So that is the justification when you write in a report. You can justify why you use net present value. That's your writing. So once you understand the reason, you can write it. You must know the reason. Right? That's why we go through all this capital structure theory, why you go through the asset beta to know the different rates. Then you can write. Understand, then you can write. Not much from the textbook, but these are the basic theory. Okay, let's go back. So gearing remain constant, then it is appropriate to use net present value. Of course, if the gearing change, we use another method called APV. Later on, we go into it. All right, So if you go into the project, you use net present value, then the cost of capital, depending on the project you go into, is it expansion? Okay, So if it's expansion, means business risk same. Gearing same, business risk same. So if you go to a new project, business risk same as now, financial risk same as now, of course, we can use a current cost of capital. Current cost of capital will have current business risk, current gearing. New project, same as current business, gearing also same as current. So expansion, we can use current cost of capital. Diversification, let's go into new business. we have to adjust for the new business risk. So we get the risk-adjusted cost of equity, but the gearing is the same. Okay, yeah? So we only adjust for the new business risk. So you have risk-adjusted cost of equity, and then you put into the cost of capital. We call that risk-adjusted cost of capital. Normally, we don't have to mention now. Normally, we straight away say WACC. Normally, we just say cost of capital. So you don't even have to put down risk-adjusted cost of capital. But if you want to explain to the marker, then you get extra marks in the word processor. Why do you go and adjust a business risk? Because it is in a new business, different from the current business. That's how you write it. That's how you write. So of course, we'll go into question, then you see how they explain. All right, So your question, normally they are diversification. All right, Step number 1, if gearing same, you use NPV. Step number 2, you have to handle inflation. All right, So inflation, there are 2 ways to handle. Normally in the exam is the first way. Okay, So inflation is given, you adjust the cash flow. All right, So let's say selling price go up by 5%, you adjust accordingly. The variable cost of the project go up by 7%, you adjust the variable cost by 7%. So after you adjust for inflation, that cash flow, we call them nominal cash flow. Nominal cash flow. So normally we adjust for inflation. So normally we use this approach here. All right, Nominal cash flow, the discount rate is a cost of capital, it's NPV. Okay, So that discount rate must be nominal also. So if this adjusts for inflation, this also adjusts for inflation. All right, So if it's a cost of capital, actually it is this one here. Actually, it's this one here. This is the nominal cost of capital. That is a nominal cost of capital. Why? Because we use market value.
Em thấy em già lắm rồi.
Okay, we use market value. Market value already include inflation.
Con thì 8 tuổi đấy.
Market value already included inflation. This is also market value. And this cost of equity and the cost of debt here, they are the current one, also included inflation. All right, So we use this formula, we actually get the nominal cost of capital. Nominal cost of capital. All right, So nominal discount rate or nominal cost of capital here, it is the one we use a formula, WACC formula. WACC formula here.
Thôi không trừ, hơn tầm 10 tuổi thôi.
Okay, So the second approach is they give you inflation. They give you inflation, but you don't care. You don't care. Right? There's a second approach. You ignore the inflation. Ignore the inflation. That means they say 5%, you don't adjust. They say 7%, you don't adjust. That's you ignore the inflation. So if you ignore the inflation, basically you're using current. That's now the value. We call that real cash flow. Ignore inflation. We call that the real cash flow. Real cash flow. Then you have to discount using real discount rate. Real discount rate. So the formula gives you the nominal. If I want to switch to the real, we have to adjust for the inflation also. Okay, So we use the Fisher's equation to adjust. Use the Fisher's equation to adjust. So I roughly explain to you the Fisher's equation. Fisher's equation. Okay, So let's go to your formula. Go to your formula. This is a Fisher's formula or Fisher's equation. Okay, forget about symbol, they are not important. Okay, I just roughly explain to you, that's all. Right? So the I here is the nominal. I is the nominal. And then the R here, it is the real. And then the H here is the inflation.
Vâng.
Okay, so you have the I, this I here. I is a nominal.
Mấy cái chị mà bạn là hết
The R, it is the real. And then the H is the inflation. So this formula simply explains to us what is a relationship between nominal. Nominal means include inflation. Real means don't include inflation. And then you have this inflation here. So if you say roughly, okay, exactly you have to work out. Let's say that the real rate, you go to the bank say that, okay, the real rate is 10%. I give you real interest rate 10%. And then the inflation is 5%. Then roughly, including inflation is how much? Roughly, including inflation should be 15%. Roughly, should be equal to 15%.
Cái quyết định đơn giá đấy là theo là món gì vậy? Nó ghi là phép trang.
Okay,
Đúng rồi. Ở đấy nhưng mà nó phải có một cái quyết định.
So including inflation should be roughly 10 plus 5. They just give you the relationship here. Right? So exactly is how much? If you work it out, actually Fisher said that it should be 15.5. So this is just roughly only. Okay, so that's giving you the relationship. The relationship.
Bảng tính đấy nữa thì theo cho em nghĩ là mình chỉ ghi.
Okay, so that's a formula. So if I want to change the nominal to the real, right? You just take 1 plus nominal, you divide by 1 plus inflation, and then minus 1. So if I want to find out what's a real, okay, I just take 1 plus nominal, and then I divide by 1 plus inflation minus 1. That means you divide only, divide by the inflation. So this is where I put it down here. So if I want to find out the real, it will be 1 plus nominal over 1 plus inflation minus 1. They give you the real cost of capital or real discount rate. Normally, nowadays, we seldom use this one here. Okay, when do you use it? Normally for long-term project, because involving annuity, then it may be faster to use this way only. But both give you the same answer. Both give you the same answer. Okay, so this one normally is for long-term project. Long-term project. Okay, this one for short-term project, normally in exam, they are the short-term project, normally. In the exam, if they have a lot of inflation, actually cannot use this one. So there's a restriction for this one here, because 1 inflation rate, you have 1 discount rate. Okay, so maybe I just put it down here. This is only suitable for one inflation rate only. One inflation rate only, because one inflation will give you one discount rate. So normally in exam, you have multiple inflation. Sales, you have one inflation, variable cost, you got one inflation, and then maybe working capital, you have a different inflation and so on. All right, yeah? So just remember in exam, normally it is this method. Just for inflation, then we calculate using the formula. But both of this one here, I go through with you. Both I go through with you. Okay, yeah? So that is the step number 2. So whenever you do MPV question or investment question, check that is MPV method, check on your inflation, and then lastly, you also have to handle taxation and format your cash flow. Format your cash flow. That is step number 3. Step number 3. All right, yeah? So your cash flow, normally when I look at the project, I will ask this question: how much do I have to invest in the project? What is the capital investment? Okay, yeah? So that cash flow, I put it down here. What is a capital cash flow? What is a capital investment here? Right, yeah? So your normal capital investment is equipment, land and building, working capital. So these are the 3 capital investment. Right, yeah? So normally it is the equipment. I put it down here for you. Equipment or machine. Equipment. You have to invest in the equipment. Or you need a space. So you have land and building. That will be your capital investment. And normally they start in year 0 immediately. And also, you also have account receivable, you have inventory, you have to give some cash, you have creditors and so on. So you also have to invest in your working capital. Okay, yeah? So you have working capital. These are your capital investment. These are your capital investment here. So those cash flow, we call them capital cash flow. Capital cash flow. And equipment, normally, they give you allowance. That is tax allowable depreciation. You can claim for taxation, right? Yeah? So we will handle on top here. Right? Yeah? So anyway, this number 2 here is your capital cash flow. Capital cash flow. And then the project will generate inflow and associated outflow. So we call that operating cash flow. So your project will generate revenues, will also cost you operating costs. And the cost here, we will include the tax allowable depreciation because you have claimed as expenses. Tax allowable depreciation. Okay, yeah, but of course, depreciation, you know, is not a cash flow. Using net present value, we need a cash flow. Okay, yeah? So revenue minus cost, which include tax allowable depreciation, give you the operating profit or taxable profit. So you pay for the taxation. And because this profit here include the non-cash flow, we now add back the tax allowable depreciation. What we want is cash flow. All right, yeah? So then you have the last one is they already handle the tax for you. They have handled the tax for you. Okay, yeah, I put it as other cash flow. As we go through the question, then I show you. All right, yeah? So all this add together will be the net cash flow. MPV, we use cost of capital. And then you get present value. And of course, then you get the net present value. Okay, so I put a note here. Ignore sunk costs. Past cost is not relevant to new project. Past cost you already spent. You take the project or you don't take the project, those costs already spent, they are irrelevant. Okay, and you also ignore the interest costs. Why? Because the interest costs, they are important, but they are already incorporated in the cost of capital. They already incorporated. That means to say when we calculate NPV, net present value, we already deducted the operating costs. We also deducted in the discounting the interest costs. So it is positive. That means you say that it is profitable. You already get rid of all those costs already. So that is a net added to the company. That's why if it's positive NPV, we say that it's financially viable. So remember this, already handle the finance costs, already handle the operating costs, everything. Everything. Capital costs also, everything. So all this you can explain, why do you ignore interest payment? No, you didn't ignore because you already incorporated in the cost of capital. So the marker then know, okay, you know why you didn't put the interest cost there, because it already included there.